How's it, Dave?
How's it, Drew? How you doing, man?
I'm very good, and you? Happy Friday.
Yeah, man. Happy Friday. Hopefully you're enjoying your time. Happy birthday for yesterday.
Yeah, thank you. It's my birthday. It was a good day, hey? It's good. It's good to spend some time with the family and just celebrate, hey?
Yeah.
And I was about to say this is Andrew and Dave's coffee chat on a Monday, but it's not. It's Friday lunchtime at 1 o'clock. We are coming to you live, ladies and gents, because we've got a very interesting topic today. Dave, what are we talking about today?
Yeah. So as many of you may or may not know, budget speech did happen a couple of days ago. So what we wanted to do is we wanted to get ABSA on to talk about what happened with the budget speech, but fortunately the budget speech wasn't too interesting this year. So we're going to spend a little
Yeah,
bit more time talking about what's happening in the market, how the economy is looking, what's ABSA's perspective on what's going on in
yeah.
the market,
And,
and how
and
and if there's any impact from the budget speech, what will it be?
Absolutely, Dave. And so I encourage all of you, please tag your friends, tag your business partners, anyone that is investing in the South African property market right now. Tag them in. Let's have a conversation around interest rates, the budget speech, the outcome of that. Like Dave said, what about Russia now invading the Ukraine? Is that going to make an impact globally? Is that going to impact us as South African property investors? So please tag your friends in. Let them know we are live right now. We've got Peter Worthington, the senior economist at ABSA Bank. We've got Miguel Martins, a portfolio manager at ABSA. Dave, let's get them online. And I know Peter has a presentation for us as well. So please ask questions in the comments box. Tag your friends in. As Peter will introduce himself in a minute, and Miguel Martins. As we're busy going through the presentation, please ask questions. We will be online for a good 30 minutes, 40 minutes, 50 minutes. There is no rush. We want to make sure that we get through all the information. Gentlemen, good afternoon.
Good afternoon.
Hello, Andrew. Hi, Dave.
Hello, Peter. Hello, Miguel. Thanks for joining us, and thanks for your time. If we can just do a quick introduction, I'm going to start with Miguel, and then Peter, introduce yourself afterwards. Let's share your slides, and we'll go through with it. So, Miguel, go for it.
Fantastic. Thanks, Andrew. So, yeah, great to be on here again. I think I've met a lot of the viewers before. My name is Miguel Martins. I sit in ABSA Home Loans. I'm a portfolio manager, and what that means is that I look after our investor segment market. So I make sure that I connect with investors. I understand what their challenges are, where they're going, what the opportunities look like out there. And then I go back into our home loans teams, and we ensure that we can enable investors to grow their portfolios in the right way.
Excellent. Thank you, Miguel. And Peter, over to you.
Thank you. I'm Peter Worthington. I'm ABSA's economist responsible for South African macro coverage. As some of you can probably hear, I'm not South African born. I'm actually Canadian, but I've been working on South Africa since '93. So I have a long arc of observations on this magnificent and tragic country.
Yeah, absolutely. So lots of experience in that field. Ladies and gents, if you've just joined us, that's Peter Worthington from ABSA, Miguel Martins. The budget speech happened at the end of February. And Peter, we want to know from your perspective, what impact is there going to be for investors like myself on the ground? And I want to have a bigger conversation that, talking around the whole Russia to Ukraine. We're going into a cycle of interest rates. And let's just have that conversation. But Peter, I do believe that you do have a presentation. Is that right?
I do, and as far as I can see, I'm showing it.
Yes, I can see it.
All
so
right,
what I'm going to suggest, Peter, and to all the viewers, I can see people are starting to join us now, Peter. There's Malcolm, you from Cape Town. Welcome. Please tag your friends in. And as Peter's going through his presentation, ladies and gentlemen, please start asking all your questions for Peter or Miguel. And when Peter's finished the presentation, we'll then take all of your questions. I've got a few questions around interest rates and all that. But Peter, I'll let you run with it.
Okay, great. Thanks very much, and good afternoon, everybody. I will sort of address some things about the budget, but I do think that we've had something much more important than the budget happen, which is Russia's invasion of Ukraine. And I don't say that it's important in a geopolitical sense, but I think it's going to have an absolutely huge economic impact on the globe and on South Africa specifically. So I'm going to address both aspects of our outlook right now. Now, I thought that, okay, I don't seem able to forward this. Have I lost control of? Okay.
There we go.
There we go. Okay. Listen, we were already looking at a situation where the global growth prospects were softening, even prior to Vlad the Mad's adventures into the Ukraine. In January, the IMF downgraded the global growth prospects by 0.5 percentage point, mainly coming from China, which is South Africa's single largest trading partner. So this is bad news. South Africa, as a small, open, commodity exporting country, we rely on the rest of the world pumping along, growing well, and that downward revision was not favorable for us. And now of course, we have the war in Europe. And what we're seeing here in this chart that I'm showing on the right-hand side is our global risk barometer. And when this risk barometer rises, it means that there is sort of risk aversion, that investors around the world want to leave risky assets, and they view generally South Africa as being a risky asset and go to places of safety, U.S. Treasuries, once upon a time Swiss franc, but I'm not sure that that's kind of a relative place of safety anymore, given the proximity of war in Europe. But the point here is that risk aversion is rising. It's not anywhere near the stratospheric levels we had 2 years ago when we had a global pandemic land on us, but it is definitely rising, and that is not good news for South Africa, because it means that investors will, in general, be less willing to put their money to work in South Africa. Where does that all net out for us? Well, listen, I'm hearing that one of the things that you guys particularly are interested in is where interest rates are going, and I totally understand why that's of huge relevance to a property investor. But before I talk about interest rates, I need to talk about the things that would affect the Reserve Bank's monetary policy deliberations. So first of all, we need to look at where we are on growth, on output levels. GDP as of Q3 was still 3% below its pre-COVID levels. We're going to get the Q4 number published next week, but we'll only make probably a 1% gain in Q4 GDP. So we're still going to be below pre-COVID levels. And if you want to look at this through the lens of employment rather than output, as you can see here from the chart on the right-hand side, we have far fewer jobs in South Africa today than we had prior to the arrival of COVID-19. Is it going to get any worse? Well, if we think about the impact of the conflict, it's not like we have really large trade or investment linkages with Russia. This table on the left-hand side, if you look at the bottom row there, you can see that in 2021, our exports to Russia were only about 0.3% of our total exports, and our imports from Russia were less than 1% of total imports. It's not great if you're a Western Cape fruit exporter and you've shipped fruit to Russia and you're not going to get paid now. But in the grand scheme of things, that's small. It's not great if you're a farmer and you were importing fertilizers from Russia and now you're going to struggle to find an alternative source of supply. But there are other suppliers. But those direct linkages are pretty tiny. More important are the indirect linkages, and where we're seeing right now the really big impact of Putin adventurism, an attempt to rewrite the global political order, is in commodity prices. Now, we had sort of some increase come through in commodity prices really from the beginning of the year, but by and large, as you can see from the chart on the right-hand side, our export commodity prices were kind of rising at more or less the same pace as our oil prices were. In the last few days, that has changed, and oil has shot up much more than our export prices are. But the important thing to remember with this is that the commodities that we export, they're a much bigger share of our export basket than oil is of our import basket. And so even though oil prices have gone up more than our export commodity prices, it may be kind of a net wash on some payments overall. But it is going to have a very clear negative effect in terms of our local inflation dynamic. all of the inflation that we have been experiencing in South Africa, at least at the level of consumer prices to date, has been driven by administered prices, things that are set by government, whether it's fuel that is set based on a formula that depends on the exchange rate and on crude oil prices, or whether it's kind of a regulatory process that sets electricity prices or municipal rates. All of those things were inflating quite significantly. But this red line here in the left-hand side chart, that's market-determined prices. And those have been really very well behaved indeed, really inflating at kind of less than the midpoint of the SARB's target range. And this is quite a different inflation dynamic from what's going on elsewhere in the globe, in Britain, in the United States, where the inflation dynamic is sort of a very broad-based demand pull inflation. The thing to remember about this, and what people don't often understand, is that oil prices aren't going to go on rising indefinitely forever. At some point, they peak out because they start choking off demand and they start encouraging new supply. We produced here in this chart on the right-hand side a little chart just to show that here's the red line is what we were forecasting based on the consensus view that oil prices would average about $82 a barrel this year. If they average $120 a barrel now, track sideways at that level, we get the orange line. We still get inflation coming back below the midpoint of the target range, just not quite as soon as we had previously expected. It comes down there by early 2023. And maybe, with oil up at $120 a barrel, we have a situation where, because let's say food distributors, their distribution costs have risen, we start to see kind of second order price increases come through. Or maybe that second order inflationary impact is because consumers are saying, hey, listen, now I'm paying much more for my petrol. I want you to give me a higher wage. Those second order effects are the kinds of things that the SARB worries about. They generally tend to look through first order impacts, or at least not try and counter them fully. Because after all, as someone said pithily recently in the supply chain discussions, higher interest rates are not going to give us more oil, more semiconductor chips, and they're not going to put shipping containers in the right ports at the right time. So there's a limit to what monetary policy can do, and they really try and react to those sort of second order, broader inflation dynamics rather than think, oh, now we're going to have oil, headline CPI at 6% because oil is 120. They know that within a year, oil will be headline CPI will come down again, because with oil tracking sideways at $120 a barrel, at the end of the year, your fuel price for oil is zero, and its contribution to headline CPI is therefore zero. But here's what it looks like in the mean, with just this fuel inflation, this red line really driving much of the volatility in headline CPI. But I need to sort of really kind of offer up an unwelcome piece of news, which is that it's not only oil. Russia and Ukraine were very significant exporters, not just of wheat, but also maize into the global market. So what we've seen is since the invasion, our grain prices have shot up quite significantly. Wonderful news if you're a South African maize or wheat farmer, but pretty bad news if you are a South African consumer, and particularly if you are a low-income consumer where these grain products are a higher share of your food consumption basket. Just to recap, output below pre-COVID levels, and output going to get a further knock from the fact that the global economy is going to be growing less strongly. Tourists may now be nervous to travel, for example. Also, growth weaker because the higher fuel prices are going to drain disposable income out of consumers' wallets. They're going to push up operating costs for businesses. Inflation rising, but mostly due to supply shocks that the SARB can't affect, but it will want to kind of stay away of any of those second order knock-on effects that I discussed. What else might fit into the SARB's debates about where to set interest rates? Well, Rand likely to be stable. Why, you might ask, against the backdrop of where investors are fleeing to safety as risk aversion rises? Well, really because of this, we're running current account surpluses. And up until South Africa had not run current account surpluses since the sanctions era. So when you're running a surplus, you're really much more robust, not completely immune, but more robust to shocks propagating out of the global economy. And here is our forecast that we have for dollar rand. We had been calling 14.75 by mid-year prior to Russia's invasion of the Ukraine. I mean, we're obviously higher than that now. But the basic message that we want to leave is that the rand should be, the fundamentals with a current account surplus should leave the rand reasonably stable. And then the final thing I think that will feed into the MPC deliberations is that credit growth remains really pretty subdued. Bank lending to corporates has just pipped back into positive territory. That's this yellow line here. Bank lending to households is here running at around 5.5%. So that's below the inflation rate currently. It's not super strong in real inflation adjusted terms. No reason for the SARB to look at this and think, my goodness, credit growth is out of control. We need to slam on the brakes. To my mind, what we've got here is a situation where there's really still no reason overall for the SARB to hike. We forecast another 125 basis points of tightening before the end of 2023. I think, given what has happened to oil prices, grain prices now, some of that might be front-loaded. So we are calling for another rate hike in March. We have a call that they will pause in May, but it's possible we could get another one in May. But really, we don't need to worry that we're going to see sort of market pricing kind of fully manifest. This is what the market is pricing in right now. The market, as of this morning, was pricing in 200 basis points of tightening within 12 months. Just to recap, that's much more hawkish than our view of 125 basis points of tightening over the next 21 months. We can have a discussion about why market pricing is far too hawkish. I will say that economists in general are kind of on the same page on this. I'm probably a bit on the dovish side of consensus of economists, but they're all kind of down around kind of where we're thinking, and they're not far away from this. Pretty much all economists who look at the South African fundamentals would agree that this market pricing is too hawkish. And I must say, I can't remember a situation in the past where there's been such a large discrepancy between what economists are predicting and what the market pricing is predicting that has persisted for so long. But listen, we can have a discussion about the reasons for that. I think there are various different ones. But I did want to cover the budget as well, because I know that was part of the brief here. So I'm moving off monetary policy and onto the budget. And, we're really, really so very lucky we had a commodity price boom. So lucky. If we hadn't had that, we would have been in a fiscal crisis. As it is, the commodity price boom has kind of given us a window of opportunity to fix our fiscus. I want to show you what this sort of what this looks like here. So because of the commodity price boom, South Africa has been able to lower its main budget deficit from nearly 10% of GDP in 2021 to a forecast 5.5 this year. This forecast 5.5, that's what we had been forecasting. And I was kind of gratified when Treasury published their budget for 2022, because they upped their estimate so that now they no longer expect a deficit of 6.6. They all expected it of 5.5, 5.6. So the same as us for 21-22. We'd expected them to narrow the deficit further in 22-23. In the end, though, Minister Godongwana is widening it out to 6. Why are we so different from, or why had we been expecting something quite so different from what Treasury actually produced? Well, for one thing, we remain a lot more optimistic on revenues in 22-23 than Treasury. We think that revenues will come in at 1,640. That's 42 billion more than Treasury's forecast. That's quite significant. But the other reason is that Godongwana spending pressures into the budget for 2022-23 that I was not anticipating. For one thing, he gave 5.2 billion in tax breaks. For another thing, although we had expected the social relief of distress grant to be extended, and it was, and although we knew that the public gratuity would be extended for another year, we did not anticipate the rest of the table on the right-hand side here. We did not anticipate or 16 billion to education, or 9 billion to residential public employment program. Was not an unreasonable approach. I didn't expect it, but with hindsight, I think the budget for 22-23 was not an unreasonable approach to kind of apportion the tax windfall from the commodity price boom between deficit reduction and meeting some really pressing expenditure priorities. The problem is that even if we think next year is okay, fiscal 22-23 is okay, Treasury's plan for the years after that looks very implausible to me. We continue to believe here that we'll outperform Treasury on tax collections. I think Treasury may be being a little bit deliberately conservative because it's always good room for an upside surprise rather than a side. And anyway, if you sort of publish generous forecast estimates, you can be sure that everybody is going to want a slice of those forecast tax revenues. Be conservative. It's kind of good way to message it going forward. But the issue is when we look at the expenditure side of the budget. So this black line, well, this yellow line is what Treasury had put into the budget for next year. That was the MTBPS. Now we've had a lot of additional expenditures kind of accommodated in the budget, and that's what Treasury had put in the budget here in 22, 23, and beyond. That's the expenditure framework. But you can see here, Treasury is forecasting that expenditures kind of stay flat in nominal terms between 23, 24, and 22, 23. That's wildly unlikely, in my opinion. Here's what Treasury is saying about public sector wages. Now, listen. We got off quite fortunately earlier this week when the Constitutional Court sided with the government on the non-implementation of the third year of the 2018 wage deal. If they had sided with the unions instead, Treasury would have been in a real serious fiscal pickle. They would have been responsible, or they would have been sort of on the hook for 75 billion rands of back pay and a lift of about 40 billion rands in the base for public sector compensation going forward. In the end, though, it didn't work out that way. But Treasury are saying, listen, we're going to get a little bit of a lift in public comp in 22-23, but then in 23-24, we're going to see it shrink in nominal terms. This is unlikely. Unions have now had 2 years of 0% pay increases aside from the cash gratuity. They're not going to accept another 3-year pay freeze. They just simply are not going to do it. So I think Treasury's hand is going to be forced here. Public Service Administration is going to agree a pay award with unions after some negotiation and posturing. And I think they're going to have to give something close to inflation. We assumed 4.5%, which would be about 27 billion. I think that's affordable. It's not going to break the bank. But another area of upside spending risk going forward, in addition to public sector wages, is what Treasury have assumed for income support for low-income households. This black in here, or the black area, this is the social relief of distress grant that got extended. Treasury's plan is that it terminates in March 23. But we won't be having labor markets that are generating lots of jobs with good incomes at that time. It's going to be politically impossible in March 23 or February 23 for government to terminate this program without replacing it with anything else. In fact, the arc of this issue is to expand this social relief of distress grant into more generous, closer towards a basic income grant with higher benefit levels and more eligibility. So I really don't see this trajectory. This is the trajectory that's in the budget, overall income support. I don't see this nominal fall coming through. Bear in mind that in February 23, next year, the ANC will be 1 year away from elections at which they might lose their majority. There's no way they're going to actually cut in nominal terms the total level of income support. And then the third big area of medium-term upside spending risk that I think is kind of important to bear in mind is state-owned enterprises. Minister Godongwana is sort of doing tough with them and saying no more bailouts for state-owned companies. But I think that it's very unlikely that he'll be able to stick with this. Treasury, Post Office says it needs 10 billion. We're not going to let Post Office close. Land Bank is unable to reach agreement so far with its creditors. It may need more money. We won't let Land Bank close. And then there are some big ones, the biggest of which is ESCOM. I think most people are of the view, as am I, that there's no way that ESCOM or any conceivable configuration of an unbundled ESCOM can service its full 392 billion rands worth of debt. Some of that debt, or at least responsibility for servicing it, is going to have to go somewhere. And really the only logical place for it to go is Treasury. It's the only place. So I think that that's kind of major upside spending risk over the medium term. So the net read for saying all of this is that we have a budget which was good. But one budget is not going to fix us. We have some really difficult fiscal challenges that will require a multi-year effort of real discipline over expenditures and real ongoing efforts to broaden the tax base, clamp down on tax avoidance, and also lift our... I'll come on to GDP growth rates in a second. This is all going to be happening against a backdrop where the service delivery is going to be compromised because we're going to need to cut expenditures to bring the deficit under control and stabilize debt to GDP. You can see here, we're experiencing or we're budgeting for real cuts per annum in expenditure on things like education, healthcare, and the like. And that's going to generate socio-political pressures. Finally, where are we kind of at kind of on this prospect of where do we end up? Well, listen, we're trying to thread the eye of a needle with the fiscus, and we've gotten lucky. That commodity price windfall was a stabilizing influence when we needed it most of all. And I think Godongwana's budget was good. And I think the reforms at SARS are going to be important. I mean, Kieswetter appears, I think, to be making headway in rehabilitating SARS. But we're in a difficult position because R is greater than G. And what I mean by that is the real interest rate on the government debt is considerably in excess of our real GDP growth rate. And when you have that, you need to be running a primary budget surplus. So the primary budget is the budget deficit less interest payments. That's this third line here. We've been running large primary deficits for a while. But because R is bigger than G, we need to be running a primary budget surplus to stabilize debt to GDP. We are only forecasting this in 24-25. The others, the only way to deal with this is if R is greater than G, and you need to run a primary budget surplus, there are only a couple of ways to deal with this. You can't do anything about R. R is what the market makes you pay on your debt. You can conceivably run a primary budget surplus, but that requires you to either hike taxes or cut spending. And that's difficult, especially for South Africa with a narrow tax base, but also very pressing socioeconomic development needs that need fiscal spending. And that leaves us with G, growth rate. So coming back to sort of the title of the presentation, reform was picking up. And the really big question for South Africa is whether we get whether we get structural reform happening across a broad enough array of areas that matter fast enough to lift our medium-term trend growth materially above where we see it right now, which is about 1.7, 1.8% per annum. I'm not sure that we're there yet, but compared to how I was viewing our reform program 6 months ago, I'm more optimistic. Unfortunately, the Russia-Ukraine conflict is not going to make our challenge lifting growth much easier. In fact, it's going to make it harder. All the more reason then for us to really go all out on the structural reform program. Unfortunately, structural reform is always difficult, because if it wasn't difficult, it would already have happened. So the only stuff that's kind of been done is the easy stuff. Unfortunately, it's not the easy stuff that really matters. We have a problem in South Africa that we have a combination of a state that has a political leadership that is not super focused and doesn't have a lot of political capital to spend on reform, combined with a bureaucracy that really exhibits more inertia than initiative. And so this makes for a very slow reform program. And we have necessary reforms in some areas, such as labor market reform, or making the state more efficient by bringing its functions online, perhaps looking at cadre deployment, or educational reforms, which are all kind of ideologically contested. And it means that we're not going to see significant action very quickly on any of these fronts. So we have a multi-year challenge ahead of us. I think I've talked for long enough, but I'm happy to take any questions that people may have.
Absolutely, Peter. Thank you so much for that. Some really good insights in terms of what's happening now. And Peter, I will be coming back to you to ask you, as a South African, should we be thinking of investing globally? Should we keep our money here in South Africa? That's a very common one I'm getting right now, Peter. But we'll cover that in a few minutes' time. I think let's get Miguel's perspective on the speech, Miguel, and then as we do that, ladies and gents, please tag your friends in. Any questions for Peter, myself, Dave, Miguel, pop them in the comment section, and we'll bring it up. And this conversation is all around the budget speech, and like you said, Peter, bigger picture now. We've got Ukraine going into, Russia going into Ukraine, and how does it impact us as South African property investors? But Miguel, if you want to give us your opinion on the budget speech.
Yeah, thanks, Andrew, and thanks, Peter. It's always a privilege to listen to someone like Peter, who kind of joins all these dots. I watch, I log on in the evening, I watch BBC, then I watch CNN. I was watching Russian today until a day and a half ago, and just trying to kind of get a sense for what's happening, right? As well as all these other changes, the budget speech, the MPC meetings, and trying to see how does this all impact me as I think about how I make my decisions and where I'm investing next. And it just really is a privilege to get someone like Peter to bring it all together, to give you a view, and his views are evolving, as he said, but at least it's something that we can kind of pull to and adds to our thinking. So what struck me about the budget speech, and just reiterating what Peter said, it was pretty much down the line. It was a solid budget speech. It didn't really. There were no massive disappointments in the speech. Yeah, exactly. The transfer duties remained at R1 million in terms of where one starts to pay transfer duty for a property purchase. What was a nice win is that if you have properties in a PTY and you're earning rental income, you're now going to pay 1% less tax. The tax rate dropped from 28 to 27%. So is it significant, or depends how big your profit is? But we'll take a win where we can. What I do take from this conversation, from that budget speech, from a lot of what's going on, is that whether it's COVID, whether it's COVID impacting your tenants and their ability to maintain their incomes and pay your rent, whether it's the interest rates which are looking to rise. There's no discussion of interest rates staying flat or going down. It's all about the increase. And as Peter said, are we going to go with 2% in terms of where the market is pointing at, or are we going to go at 1.25 in terms of where ABSA is forecasting? Well, it's going to be somewhere in between, right? So how as property investors are we thinking about that? And then as a bank, and as home loans, how does this play into how we look at our customers who are applying for finance with us? Of course, the more turbulent the environment, risk appetites start to tighten up. We start to really look very carefully at customers, ensuring that we are taking a risk on the right customers, and that's where it's incredibly important, not just to maintain your rental business if you're already a property investor, but ensure that you maintain your credit score, ensure that you arrive at the bank with application as a right kind of client that the bank wants to take a risk on. So as always, good to look at the big picture, but bring it back to yourself and make sure that you're at least keeping tabs and keeping yourself and your property business robust to these changes.
Absolutely. Thank you, Miguel. So Peter, give us your thoughts with interest rates. Obviously, interest rates are going up, and I think, Miguel, were you talking about 8.25 is what ABSA Bank's thinking? Let's get Peter's thoughts on that as well.
So, Peter, I think you said a further 1.25 from where we are today by December next year, right?
By December next year, yeah. And with some and another hike in March at the MPC coming up soon. We have a call on that the MPC will pause in May. But I wouldn't say that that's a very high conviction call. I think it's going to be highly data dependent. In other words, if the data continue to look bad, oil prices are high, upside inflation risks are high, it's possible that we could have the SARB kind of front loading some of that. But to just come back to what I was saying, again, we really don't have any reason for the SARB MPC to be super aggressive with ratings. So yeah, another 125 kind of gradually between now and N23, but perhaps a little bit front loaded if these upside inflation risks, particularly oil and grain, kind of persist. I think, and I get asked a lot, what's our terminal rate for the repo rate, and then prime 3.5 percentage points above that. So I don't think we're going to go back to the level of interest rates that prevailed prior to sort of COVID. We have a sort of a terminal repo rate of around 6.5%. So that would imply kind of prime at 10. But we don't think we're going to get there very quickly at all. It's going to be quite gradual, and it could well end up being lower than that.
And Peter, as you're talking there, so another 1.25% takes us to about 8.5% prime at the end of next year. That's still below the 10% pre-COVID.
Yeah,
and I almost want to suggest that as much as interest rates have a massive impact on investor cash flows, I think the bigger impact is around comments around unemployment, around
tenants not paying,
on tenants' disposable incomes, petrol, etc.
Right.
So yeah, one of those one of those risks are interest rates, but we mustn't forget the other risks of can I find a good quality tenant who hasn't gotten into trouble before, and my tenants that I have currently, they may get into trouble in the future. So it's about really managing your portfolio tightly.
Listen, I think that's right. We have this situation that I showed with the employment here. According to the latest data that were published by Stats SA, there were 2.2 million fewer jobs in Q3 than prior to COVID. Now, most of those job losses have occurred at the very low end of the income spectrum. When we look at the employment data broken down by skill category, we see that semi-skilled and skilled employment is back at pre-COVID levels, but unskilled labor is not. And the bulk of those job losses actually occurred in the informal sector and in things like domestic service. So what you're getting there is sort of a real segmentation and a more inequality coming through. I think, for consumers at the upper end of the income spectrum, though, they're the ones that are going to sort of enjoy nice wage increases coming through. Financial sector, probably is going to do relatively well. But all consumers are going to feel the pinch of higher fuel prices, whether directly to fuel your own car or indirectly via price hikes that are going to come through for public transport. But I think the pain is going to be particularly tough for people at the low end of the income spectrum. And remember, those are the ones who are also going to be paying relatively more out of their wallets. A larger proportion of their wallets will go now to grain products and in general foodstuffs that rise in price.
One thing we've seen on our side is a shift, a slight shift in terms of the number of first-time home buyers taking up home loans. So it's a slight drop, but we look at these small ones and we look at the trends, and what that talks to is because of the increasing interest rates, where initially a first-time buyer could look at taking up a home loan. Now they're either concerned about further increases, or the increase just takes them out of affordability. What that possibly means is that they continue renting. So these things don't happen in massive shifts. You don't necessarily see the massive impacts, but you definitely see a larger rental market as an outcome of that. And of course, as interest rates increase further, but definitely seeing that's a small trend.
Awesome. And Dave, your side?
Yeah, I mean, I think I'm quite intrigued by how the Russia and Ukraine conflict is affecting our markets at the moment. It's interesting to see how that is going to drive movements, especially in, like you said, agricultural sectors. I don't think as property investors we're going to see a short-term impact on what's happening over there. But yeah, I don't think I have any questions at the moment.
No, all good. And I mean, Peter, from your side, we deal with lots of SA investors, right, who are investing here in South Africa. Some investors have properties offshore in America and England, in Australia and Africa. If you're an investor here in South Africa, should we be focusing on onshore or offshore? What's your view on that point?
Well, listen, it depends. You're talking about property. We have a forecast that property prices sort of will continue to rise. I think the rental market is probably going to remain under sort of, we're not looking at a booming rental market in my opinion. And I want to stress, I don't kind of look at property specifically, so I'm not an expert in this, but it would seem to me, we have lots of supply. Working from home is going to remain a feature. There's going to be less demand for property for sort of second homes as people are commuting from the coast up to work in Gauteng. There would seem to me to be less demand for property from foreigners, particularly against the backdrop of kind of heightened global risk aversion. I think we're not going to see sort of super rapid. The upper income segment, they might do quite well, but I think middle income South Africa is going to be very squeezed, and low income South Africa we've kind of talked about there. So that's sort of some comments as from the point of view of a macroeconomist, kind of on the outlook there. On the question of domestic versus foreign, listen, our view is that the rand is going to be stable for a while. But diversification is always a good thing.
Yep.
Diversification is always a good thing, especially if you're sitting in a risky asset.
Absolutely, absolutely. And I think, Miguel, a question I want to ask you, so most of our investors are getting into residential, be it multi-lets, blocks of flats. What about the other sectors like the industrial sector, and what about retail, and what about office space and all different sectors in the property market? What's your view on that? Should we keep investing in our multi-lets, our blocks of flats, the residential market, or should we be looking at other sectors like getting into industrial, right?
Sure, Andrew. Now you're really stretching me. I think I have a grip on the residential market. I definitely don't have a firm grip on those other sectors. What I would say is that if you look into those other sectors, you can't do enough research and you can't speak to enough people already in that before you take the plunge. So, as Peter said, it's good to be diversified. I think many investors graduate from residential into other commercial type properties. But I think at every step, I think it's about doing the homework. It's about understanding the dynamics, understanding how your current portfolio fits into a portfolio like that, how it complements it, and how it evolves. But the different sectors, what I do know, are definitely experiencing different trends and impacts at the moment.
Yeah, definitely. And Dave, from your side, any comments around the sector, like industrial, commercial, retail, office space versus your bog standard multi-lets, residential?
So I think where we've got some good growth, as a Cape Town investor, I can often comment specifically on the Western Cape perspective. We've definitely seen a spike. We've got Amazon offices coming up over here. So our sort of service accommodation as well as service office space is going to take quite a nice sort of uplift, especially in and around those sectors. The city of Cape Town and the Western Cape government have done a big push on our visa requirements and allowing those sort of remote workers to come and spend time in South Africa and work from here, and that'll see a bump in, for me at least, in the commercial office space. Some in the Airbnb and service housing sectors, I don't see any new demand in the industrial sector here, but Cape Town typically and historically has quite a shortage in those sectors.
Yeah.
So it's going to be really good to see if we can start catching up on that. I don't know entirely what the Amazon campus is going to do to us. The first round of effects is a couple of 100 square meters of office space, which means a couple of 1,000 people needing housing and accommodation and transport in those areas, and then there's the secondary effects of those of
more traffic.
increased retail, increased like industrial shipping is obviously one of those things, and more traffic for Cape Townians.
And Andrew, I think just this is an interesting conversation because it's quite, if you're already invested in residential, the intrinsic characteristic of property that's difficult. It's difficult to get in, difficult to get out. It's expensive, it's timely, etc. People are working from home more. So I think as an existing property investor, what are you doing to improve your apartment, your property for work from home space? Are you looking at Wi-Fi capability? Even if it's paid for by the tenant, but are you ensuring that you got the best possible Wi-Fi there? As Dave says, with companies moving in, and these digital nomads coming, in from Europe and being able to stay in the same time zone as the offices back in Europe, how are we servicing that? And I think it's about you've still got your property portfolio, you've still got your apartment, your multi-let, etc. How are you evolving your proposition and your product given these trends? COVID, the disease has come and to some degree gone, but the effects are still here. The way it's impacted society and how we live, etc., are still here. So how are we leveraging that, to the benefit, and how are you getting ahead of your competition, who's also got an apartment or an Airbnb to let down the road? So I think those are definitely some takeaways that I take from these big, massive moves.
Absolutely. Dave, any comments there? Or are you good?
Yeah, no, I'm with Miguel. It's been an interesting thing. We've seen the impact, especially for me in the commercial sort of service office space. I saw a huge impact when COVID came in because all of a sudden people were working from home. I think we're seeing a recovery in those sectors, which is nice. I've got concerns. I've started hearing mutterings about another wave of COVID, which I'd really avoid if I could. But only time will tell what COVID does to us as May rolls around.
Absolutely. Okay, cool, gents. Thank you so much for your time, Miguel and Peter. But Peter, what is one thing you'd like to leave our audience today? Is there anything you'd like to leave our viewers? Should we be positive, negative, on the fence? What would you say to all of them?
Oh, there's a good question. I want to leave with a good thought. Listen, I guess the thing that I would say is that, I think we're moving in the right direction on the policy front of government, but we have enormous challenges which are not going to be easy to fix. And investors might want to be positioned for that. I wouldn't want to be putting all of my own eggs in a South African basket. That's probably what I would want to leave people with.
Okay, fantastic.
Comes back to that diversification point.
Yeah, and diversify.
Yeah.
Which is good. Awesome, Peter. Thank you very much for your time. Let's go to Miguel and get Miguel's last words of wisdom. Miguel, what would you like to leave the audience today?
You know, a month ago, we would never have thought that we'd be at this point with Russia invading Ukraine and the impact that it's having and these massive sanctions. You know, a month ago, we're still talking. Sure, 2 months ago, we're worried about not being able to fly to the US and the UK, and look how that turned around. Things change. Things change, and 3 months, 6 months, a year from now, it will be something else, either globally, nationally, or in your environment. And I think it's about you know, as a property investor and as an investor, it's about ensuring that you've got a robust portfolio, you've got great tenants, you are maintaining not just your property but your relationship with your tenants, that you've got some savings on the side so that when you have vacancies, when you have these knocks, if interest rates were to spike for a short term, you could handle that.
Exactly.
Etc. You know, so it's really about thinking about your property in the same way Peter spoke about South Africa Inc. You know, think about your property Inc. and make sure that you treat your property like a business, and that you take care of it. It'll take care of you. From an ABSA home loans perspective, we, you know, as Peter said, we look through these short-term shocks. And you know, we're still very much open for business. We're doing 100% LTVs on loans. For individuals and PTYs and trusts, and we're really keen to support that. But we do then, you know, start to look very carefully at the applicant, ensure that they have a good credit score, they're managing their existing properties and the existing debt carefully, and it's a risk we're willing to take to help them grow their property portfolio.
Absolutely. Thank you so much, Miguel. So, Peter and Miguel, thank you for your time. I think we've come to the end of it, unless there's any further comments from your side, Dave, or we're good?
No, we're good. Thanks.
We're good. Peter, thank you very much. And Miguel, thank you. I'll stay online with Dave for 2 minutes, and then we'll take it from there.
Thank you.
All right. Thanks.
Awesome. Thank you, Peter. Thank you, Miguel. Awesome, Dave. That was very interesting, man. Talking about the budget speech and the outcome and the global and the impact and inflation and interest rates. And I think Miguel touched on something there about you can never be prepared enough, right? Plan for the best, prepare for the worst. Like he said, who would ever think that Russia's going to go invade Ukraine? And even if that gets sorted, there's going to be something else that comes up, right? Be it the second wave of COVID or whatever it's going to be. You've just got to be as prepared as possible. What do you think, Dave?
I mean, just as an example, so I've been talking to Miguel about this live stream since January, and the topic's gone from, okay, cool, we're going to focus on budget speech, to the budget speech doesn't look like there's going to be much in it, so let's talk about the economy. And then in the past week, it's become, okay, cool, the economy is completely impacted by what's happened with the Russia-Ukraine conflict.
And agricultural. Oh, no, it's hectic. And I think investors need to keep up to speed and need to know what they're doing. And that's why we have the SA Property Investors Network, ladies and gents, where we keep all of our members up to date with what's going on around the world and how these big changes impact us as South African investors. Should we keep investing in South Africa? Should we be diversifying our wealth into, say, America, into UK, into Australia? I think it's important to spread your net. You know, yes, invest in South Africa. We are investing in South Africa, but if you have the option of getting some of your funds offshore, it might be something to look at. But yeah, Dave, I think that's everything from our side. And thanks to all of you. Sats, good to see you on there. Julia, Shilly Boy. Let's maybe talk about that for a second, Dave. What's happening on the 16th of March?
So let me quickly just grab my calendar. Sorry, I wasn't prepared for that question.
No problem at all.
So very high level, just as a reminder, we've got Andrew, you and I are back again Monday, 1 o'clock for our usual coffee chat. We will be taking some questions from the audience. So guys, if you want, you can take a look at our Instagram page over the weekend, ask your questions, and then Andrew will hit that on Monday. But on the 16th, we have a networking event up in Joburg. It's going to be really fun and exciting. It's going to be taking place at the Bryanston Country Club. We're going to get Shilly Boy to come talk to us about the tax planning and specifically how the budget speech has affected our tax planning for the rest of the year. plus side, for those of you guys who can't be in Joburg, we will be live streaming it out to Cape Town, Durban, where's Yaku again, Belgium.
Belgium,
So
yeah.
we'll be live streaming for everyone who can't make it. But Andrew, you've spoken to Shelly Boy about what we're covering there. So what else do you have on that one?
Yeah, so I think it's exactly what you said. So Shirley Boy is a tax expert from Intergen. He'll be accompanied by Bruno. They're going to talk through all investors. Whether you'd like to get into the property market or you're in the property market, how will the budget speech, the outcome of that from a tax perspective, looking at 28 down to 27, and just ensuring that you are all investing in the right entities, that you understand the tax elements of it. And I think that's really important for all the investors, and that's why we live streaming it. So if you are in the Gauteng, Joburg area, make sure you join myself and Shirley Boy and the team on the 16th of March from 6:30. Just go to our website at www.sapropertynetwork.com. Dave will post the link online anyway, and join us for the event. All the other partners will also be there, including ABSA Bank and all our partners and sponsors. A great opportunity to network, learn, and get inspired. But I think, Dave, that's it. I think we've covered quite a lot in an hour.
Yeah, 100%. So like Drew said, I'm quickly putting the link over here for our events, as well as I'll put a link over here for ABSA. So if you do want to connect with the ABSA team, of course, thank you, Miguel, and thank you to Peter for joining us. It was really good to have everyone on. And if you want to connect with the ABSA team, I'll put a link over there in a few seconds.
Absolutely. Awesome. Thank you very much, Dave. Thanks, everyone. Have a great Friday, a great afternoon, a great weekend. And Dave and I will see you on Monday at our coffee chat on Monday.
Perfect. Thanks so much, Drew. And we'll see you all on Monday. Thanks so much.
Awesome. Cheers, everyone.
Cool.